US stocks have recovered relatively aggressively from November lows, pushing up with the Dow Jones up to 48,000 and the S&P 500s trading at around a 3-week high. So what's been driving this recovery? Well, we've seen rising December Federal Reserve rate cut expectations. We've seen weaker data. ADP payrolls fell by 32,000 this week. That was the worst level in 18 months. And we've seen sort of other pieces of data which have also just pointed to that weakness. We've seen the ISM manufacturing was also a little bit weaker. And so there has been this growing expectation that that softness in the labour market will be a reason for the Federal Reserve to cut interest rates next week. Several policy makers have also highlighted weakness in the labour market as a reason to cut rates. So expectations for a rate cut from the Federal Reserve next week is now up just below 90%. That's recovered from around 30% just a few weeks ago. So that's really been the main driver of this recovery that we've seen. I think the other thing to keep in mind here is we have seen also rising expectations of Kevin Hassett, the White House economic advisor, becoming the replacement or the new Fed chair, replacing Federal Reserve Chair Jerome Powell in May next year when his term ends. Now, Kevin Hassett is also renowned for being a monetary policy dove. He's very much aligned with Trump's thinking about lower rates. So the market's also got a little bit excited that potentially we could see a more dovish Federal Reserve chair next year, which could also mean more interest rates to come next week. Now, I don't think that's necessarily going to be the case because obviously this is a committee and there are sort of, he would need to have the economic data in order to back those more dovish opinions. Otherwise, he'll find himself in a similar to position where Stephen Mirren is at the moment. And that's basically, pointing towards a more dovish stance, but without much support. The other thing to keep in mind is what could really knock this rally off track. And I think there we do actually need to look at two things. Firstly, if the Federal Reserve does cut interest rates, but we see Powell adopt a more hawkish cut, which I think is pretty likely as a way to be able to appease the relatively divided committee. That might give the market a little bit of concern. We may see that as a reason to keep the upside limited. Other thing to be watching out for is what's going on in Japan. We've seen the strengthening of the Japanese yen. We've seen rising expectations up to about 86% now that the Bank of Japan is going to be cutting interest rates in the December meeting. Now, what happens is the concern here is the unwinding of the yen carry trade, which could technically withdraw liquidity from the rest of the market, the global market. And that means that areas that are sort of particularly tech stocks, crypto, those are areas that tend to be affected by such moves. So that would be another one to be watching out for as we head into the later days of December. But for now, the S&P 500, as I said, it's trading around a 3-week high. It's recovered from the 6,500 low to around 68.60. So as I mentioned, the recovery does appear to be running out of steam. Should we see momentum pick up? We've got core PCE data tomorrow, cooler than expected. Core PCE, which is the Fed's preferred gauge for inflation, could see the S&P 500 push up towards the 69.20 record high levels in order to move on towards fresh record highs. On the downside, looking at support 67.50, which is the early October high, and also the 50 SMA. Below here, 6,500 comes into focus as the November low.